Contentious issues in private business valuations. Number 5, is it? Number 5. PE multiples or earnings multiples, revenue multiples. What do they mean and what are some of the issues? So multiples are a form of pricing. What we're doing is we're looking at comparable transactions, comparable companies to the business we're valuing, implying multiples based on revenue or earnings, and then applying that multiple to the revenue or earnings in our object company. There's a few issues. Firstly, we need to make sure we're consistent. So if we're taking historical revenue multiples, historical earning multiples, we need to apply those to our same company on a historical basis. Likewise, if we're taking observing future multiples, we need to apply future multiples. So we need to make sure we're consistent. And like I say, multiples are a form of pricing. It isn't a form of intrinsic valuation. Now, a lot of practitioners would disagree, and I appreciate that, because they would say, well, an earnings multiple is actually a capitalization. And what are they saying? Well, a capitalization rate is the discount rate, the cost of capital, minus the growth rate. And a multiple is the inverse of that. So say, for example, we have a cost of capital of 30%, a growth rate of 5%, 30% minus 5% is 25%. That's our capitalization rate. If we inverse that, so 1 divided by 25% gives us a multiple of 4. If we times multiple of 4 times our earnings, that's effectively capitalizing our earnings. The problem with it is we haven't gone through all the factors that we talked in episode number 3. We haven't thought about how we're building up our cost of equity, include our risk-free rate, our equity risk premium. We haven't looked at our cost of debt, how much debt is in the business, and we haven't looked at our debt to equity ratio. We've ignored all those factors. Also, the problem with a earnings multiple capitalization is assuming it's fairly low growth. Why is that? Because if we suddenly have a lot of growth, you can see the equation starts to fall apart. So if we have a 25% cost of capital and then our growth is, say, 20%, our capitalization rate is then only 5%. We start getting meaningless numbers. If it's 25% growth, we've got a capitalization rate of 0. So we have to be careful about when we use our capitalization, and it only applies to businesses if the earnings are really steady with very low growth.